Hi, everybody. This is David Gully from Bentley University. This is the March 2023 Monetary Policy Update. This is Anatomy of a Bank Run. This is Silicon Valley Bank. Please visit our YouTube channel, Bentley University EC391. So our agenda today will be background on Silicon Valley Bank. We'll talk about the factors contributing to its collapse. We'll talk about the policy response. We'll talk about the impact of the financial system, and then finally the impact, at least so far, on the economy. Because remember, we're recording this only 2 weeks after the fact, and so a lot of the long-term factors haven't yet manifested themselves. So some quick background here. By assets, this is the second largest bank failure we've ever seen, and the largest since the Great Recession in 2008. Overall, it was the 16th largest bank with just a bit over $200 billion worth of assets. It was mainly focused its operations in California, and even within there, it was mainly focused on the tech, venture capital, startup sector. Deposits of the bank grew extremely rapidly during the 2010s and then grew extraordinarily rapidly from 2019 to 2021. And until it failed, it had not been designated as what's known as a systemically important bank. And that'll be important here for us in just a couple of minutes. And so what we want to do here is go through and talk about the various numerous factors that contributed to SVB's fall. And the way we'll start this is with their balance sheet. And the last balance sheet we have from them is the end of 2022. It will work. It'd be better to have a more recent one, of course, but it will get the job done. And I'm not going to include every single component of the balance sheet because most of them are normal and ordinary things. I'm only going to worry about the parts that are particularly important for our story. And so first, let's take a look at the liability side. Okay, so in other words, the source of funds for the bank. So just under 10% of their liabilities were in debt form, both short and long-term debt. Around 8% of their liabilities were equities, shareholders, and 82% were depositors. And that's going to be very important for us here going forward. Over on the left-hand side, so the idea is the bank takes its liabilities and it acquires various assets. So just under 10% of their assets were U.S. Treasury securities. Close to half of their assets were mortgage-backed securities. They had around a third of their assets in the form of loans. And then they had about 6% in terms of cash. It could be reserves with the Fed or other marketable short-term securities. And so let's take a look at the deposits. This is going to be an important part of our story here. The vast majority of Silicon Valley Bank's deposits were uninsured. In other words, they were above $250,000 limit imposed by the FDIC. And you can see, and this is going to be an important part of our story too here, that even in 2022, deposits were already starting to decline. So let's look in a little more detail at the components of the balance sheet that are going to be very useful to us here. So if you look at the asset side, mortgage-backed securities, treasuries, loans, these seem like standard things that banks would have. But here's the difficulty, is that from March 2022 till currently, long-term interest rates rose pretty dramatically. And what this did is it reduced very dramatically the market value of many of SVB's assets. Now, what's interesting is that of their treasuries and mortgage-backed securities, a substantial fraction of those were marked as or listed as held to maturity. What this means is they don't, according to accounting rules, have to mark them to market. In other words, they don't have to lower the value of the assets given the fact that the prices or the values in markets have fallen, because they were marking them or saying that, well, we're going to hold these to maturity. And so as a result, we don't really need to mark them to market. What we also want to emphasize here is that in past bank failures, like, for example, during 2008, the Great Recession, many banks failed because of defaults of their assets, either on their loan portfolio or, at the time, the very terrible mortgage-backed securities that they owned. Well, that's not the case here. There's no real evidence that, despite the fact that they were mostly making loans to tech-related companies, startups, and so forth, that these loans were having any larger default rates than normal. So this, in this particular case, is not a factor here. Over on the liability side, it had very standard bank liabilities, had deposits, equity, and a mix of short and long-term debt. SVB's problem, though, was that as we just saw, a vast majority of these deposits were above $250,000, the FDIC limit, and they were extraordinarily concentrated among a very narrow group of individuals and businesses, tech startups, venture capitalists, and so forth. And so what happened starting in mid and especially late 2022, funding for tech-related companies tended to decline. Well, in order to make sure they're making payroll and other daily expenses, they started pulling out their deposits from SVB. We just saw a minute ago that deposits were declining even during 2022. Well, what this eventually required here in March 2023 were some asset sales. And again, we'll get to that here in just a second. So here's the basic problem that SVB had. They had what's known as a duration mismatch. They had long-term assets, treasuries and mortgage-backed securities, and to a lesser extent, their loans. And they had short-term liabilities, deposits, meaning the idea is that deposits can leave literally any day, at any time, for any reason. Now, under normal circumstances, this duration mismatch can be exceptionally profitable, especially if longer-term interest rates are notably higher than short-term interest rates. The old banker saying you borrow short and lend long. If that's the case, then you earn a very positive net interest margin. And of course, that's very beneficial to the bank. But the difficulty that SVB faced, and many other banks too, is that market interest rates went up and the yield curve flattened, meaning short-term interest rates were as high or perhaps even higher than long-term interest rates. And so when you combine the decline in the value of assets with the deposit outflows, and we'll talk about more about the deposit outflows here in just a minute, this led to a ratings downgrade. The financial rating firms were concerned about SVB's financial prospects. And what we ended up seeing was a very standard, though very accelerated, run on the bank. They tried to do a capital raise. I've sort of shorthanded it here, a raise, that's sort of inside baseball a little bit, of around $2 billion the week before they failed. Didn't work out, and the FDIC ended up taking the bank over the afternoon of March 10th. Now, what's interesting here is that SVB was flashing a lot of warning signs. And so, as you can see here, throughout more or less all of 2022, that the price of SVB stock was declining, and declining very, very dramatically, far more than the overall, say S&P 500 or the NASDAQ or the Dow Jones. And so warning signs were being very, very clearly indicated here by the price of its stock. Now, there's a whole number of factors that have contributed to SVB's collapse, and we want to go through these and talk about them one at a time. The first and most important one is management. These are the folks who are in charge of the bank, and they're really, at the end, responsible for its success, or in this case, its failure. The difficulty on SVB's balance sheet was not the credit risk or the default risk of its assets. It was interest rate risk, meaning as market interest rates rose, the market value of his assets declined pretty substantially. They also were a highly concentrated bank in terms of who they did business with. They did business, as we've noted, with mostly tech and tech-related companies. This concentration means they're not very well diversified. So if there are any issues in the tech industry, and as we mentioned, they were having funding difficulties throughout 2022, that's going to translate to problems with SVB. They also put their customers, many of them, in what's known as a bear hug, meaning the condition of making a loan from SVB to a company was, in return, the company would hold all its deposits with SVB. So a particular tech company would have its working capital there, so its funds to make payroll and pay its other bills along with its loans. So this concentrated business within SVB. We also, as we've noted, they had a very high level of uninsured deposits, meaning the people who had these deposits had no guarantee that they're going to be protected in the event of a collapse of the bank. And so they had a lot of incentive to try to move the money out as quickly as possible. And then finally, and this is not every problem, but you'll get the idea here, is that they did not have a chief risk officer for the vast majority of 2022. And so this was maybe signaling the importance or lack thereof that SVB put on managing its risks. Another issue is the Fed's policy shift in 2022. Starting in March, they began raising market level interest rates. And in addition, in 2022, we saw a substantial increase in the rate of inflation. And those two factors combined, and this is the important part, work to push up market interest rates. And as we've discussed, what that tends to do is that reduces the value of the asset side of SVB's balance sheet. And so since they had, as we mentioned, a really large portfolio of long-term fixed income assets, in other words, whose cash flows did not change with inflation, the value of those assets fell, and they fell dramatically. And the difficulty came when they were experiencing deposit outflows. And to meet the needs of those depositors who want to withdraw their money, they needed to make asset sales. And that being done in a declining value market caused some problems. The other thing we want to emphasize, and I've got a visual here in this on the next slide, is that the Fed's current rate hike cycle has been very, very fast and very, very large, historically so. And so here we are. This is a visual from the Wall Street Journal, and you can see here what it does on the vertical axis, during a given cycle, all the different colors there, the rate at which interest rates were increasing, the federal funds rate. And so here we are. This is the most recent increase beginning in March 2022 till currently, just last week, as a matter of fact. And you can see two factors that stick out. First, how quickly interest rates rose relative to, for example, the cycle that started in 2015, the cycle that started in the 2000s. This is the cycle that started in the late 80s, for example. And so the speed, and notice how many percentage points interest rates rose. So the idea here is that as interest rates rose dramatically, and they rose quickly, this caused a very dramatic decline in SVB's marketable assets. Another factor that needs some attention is social media. And what we want to emphasize here is this did not cause SVB to collapse, but it made its collapse more spectacular. So we've talked about already, well, SVB had a very narrow clientele, the tech industry in California. Well, I'm exaggerating here to make a point, but generally they all follow each other on social media. I'm using Twitter here as the running example. And so once there were rumors of problems, once they had the downgrade, that information was communicated very, very quickly within that very narrow community. And the fact that this very narrow, very well-connected community all knew that there were problems with SVB and that they could access their accounts very quickly on their phones, or worse, their laptops, they were able to try, and this is the key word here, try to withdraw $42 billion over several days. Historically, the way bank runs worked is people had to line up. And so it took a while for physically all the cash and, or in some cases, checks to be written out. In other words, how fast could the tellers work? Here, since it's all electronic, that process accelerated multiple times. And so as a result, SVB was simply not able to keep up. We also have to talk about regulators. And here I mean the Fed, the Treasury, FDIC, the state-backed regulators, and so forth. And one of the first questions that you should be thinking about is, well, okay, post-2008, post-Great Financial Crisis, post-Dodd-Frank, that's the main legislation that came out of this, Weren't those regulations supposed to make a repeat of 2008 much less likely? And the answer is yes, but the difficulty is it's very hard to do so for every single bank in every single situation. For example, the Fed in 2019 and 2020 issued warnings to them in terms of their risk monitoring system. And in his March 2023 press conference, this is a direct quote from Jerome Powell, that the Fed's supervisory team was, quote, actively engaged with SVB. So the Fed was not caught unaware that SVB had problems. Indeed, in the several days just prior to its collapse, it was working to get funding from FHLB, that's the Federal Home Loan Bank, and the San Francisco Fed, the various regional Feds. They're the ones that administer the discount window where a bank would go if it needs to borrow money. They were trying to borrow funds, trying to put up collateral in order to get a loan to help fund their deposit withdrawals. Well, they weren't able to move quickly enough. The regulators weren't. And so as a result, any possibility there didn't work out. And then there's the Fed's stress test. Now, these were created post-2008 to simulate various problematic financial market or economic scenarios. And the idea is to put these banks through these stress tests to identify problem areas that might develop and head off those problems before they actually show up in a real situation. But the irony is very interesting here, is that these various scenarios included all sorts of various negative economic and financial shocks. What they did not include is a Fed-induced increase in market interest rates. The irony. Now, what we want to also talk about here is that, and mentioned this at the very beginning, SVB was not designated as a systemically important bank, meaning it wasn't subject to the extra strict capital rules of Dodd-Frank. It now is, or was anyways. And here's the key. That designation allowed temporarily the Treasury and the FDIC especially to guarantee all the bank's deposits. And we'll talk about that deposit guarantee just in just a few minutes here. The real objective here, and this is the critical part, is to limit contagion, meaning it's bad to have one bank fail. It's terrible to have many banks fail. Banking system depends critically, and I cannot emphasize this enough, on confidence, because not everybody can all withdraw their money all at once. That doesn't work out. So if you can prop up, even temporarily, the rest of the banking system through increasing and maintaining confidence, you can get over the initial problem, the one bank failing perhaps, deal with it, and hopefully, in the near term at least, prevent other banks from following suit. Now, overall though, and I want to emphasize this, bank regulations and banks in general are much safer than they were pre and during the great financial crisis. There are tighter lending standards, higher levels of capital, which allow them more flexibility to absorb shocks, and in general, better risk management, though, as we mentioned, SVB might be the exception there that proves the rule. So those are all good things. Yeah, they are, but there's always consequences of regulations, positive ones, hopefully, but also sometimes negative ones that are perhaps sometimes unintended. A recent paper, Falk Ronning and Flay in 2020, Falk, by the way, is at the Boston Fed. I've met him. He's a very nice man. Is that Dodd-Frank required lots of things of banks, one of which is to diversify their asset portfolios and make them safer from default risk, not necessarily interest rate risk, as we mentioned. But one of the consequences is that banks became, especially large banks, became more similar to each other in terms of what their asset portfolios look like. And so what we observed is that within a bank, portfolio diversification increased, but across banks, diversification fell. In other words, all banks look more or less like each other. So here's the problem. So banks might be safer from credit risk, in other words, default risk, and that's a good thing to be sure. but their balance sheets now look more similar. So if some shock comes along that hurts one particular bank and its portfolio, then this shock is more likely to hurt other banks because they look similar to this one bank who's having difficulties. And so here's a visual. This is directly from their paper. And there are various ways to measure similarity. And they chose 3 of them. I'm not going to bother us with the details. But notice here, so 2012, this is when the Dodd-Frank stress test became active. And so notice that post Dodd-Frank, on the vertical axis here, this is similarity. And so their measures of similarity across the 19 biggest banks. So DF, that's Dodd-Frank's. The Dodd-Frank, these are the banks that are subject to the stress test. They become more similar relative to the pre-Dodd-Frank banks. And so this indicates that they're becoming more similar, and as a result, might be all subject to the same set of risks. So another factor that we want to investigate is, well, are there more SVB type banks out there? So if you look at SVB compared to other banks, relative to these other banks, it had more of its assets marked as being held to maturity. In other words, they're not marked to market. Their assets aren't revalued to reflect current market prices. And as we've seen, a very large fraction of their deposits are uninsured or were uninsured. So in this sense, SVB was riskier than most other banks, but not, as we'll see here in a minute, not all of them. So for example, Signature Bank, they've also had problems as well. They fall into this similar category, and that bank failed too. And so if you listen to Jerome Powell, this is a direct quote from his most recent press conference in March 2023. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its, that should be its holdings of duration risk. So we have a visual here, and this is directly from the paper. And so we have 2 questions we want to answer. So if assets were marked to market, by how much would the asset side of a bank's portfolio fall? So these charts are derived from FDIC data. And the way you interpret, let's look at the left chart first here. So on the vertical axis, these are roughly in percent. And then the horizontal axis, notice, runs from 0 to 30. And so if you look right here, 0, what this would mean is that a bank's assets were such that if it were marked to markets, its assets would fall by 0%. So there were a few banks who had no problems in terms of having their assets marked to market. But note that for most banks, given their asset portfolios, if you marked all of their assets to market, then the value of their assets, their market value of their assets, would decline. And notice the scale runs from 0 all the way down to about 30%. And this vertical dotted line here, that's SVB. And so most banks would see their asset portfolio fall less than SVB. But notice there are an uncomfortably large number of banks whose assets would fall not by as much as SVB's, but by even more. So those banks might be a little bit worried at this moment. So another metric that we've talked about as well, what's the ratio of uninsured deposits to assets? That's the graph on the right. And so here, notice this runs from 0 up to 100, that's the maximum. And our 2 dotted lines here, those are again SVB. So here, SVB is a real outlier in terms of the fraction of its assets that are represented by uninsured deposits. And what they've done here is notice they've got pink bars and they've got gray bars. The pink bars are not assets marked to market. The gray bars, just like the graph on the left, is what would happen if they were marked to market. And so the intuition is, notice that SVB's percentage of assets that are represented by uninsured deposits would move even closer to 100% if its assets were marked to market. But notice critically here that in this respect, SVB is a dramatic outlier. There are nearly no other banks that have this ratio of uninsured deposits to overall assets. At the aggregate bank level across the United States, we can see this. This is a chart that just came out this week in the Wall Street Journal. Unrealized losses on combined collective bank balance sheet. So remember, we mentioned that we have interest rate risk. As market interest rates rise, the value of bank assets, at least some bank assets, decline. And you can see here, that's the first, the second, the third, and the fourth quarter of 2022. So as the Federal Reserve was raising interest rates, as nominal interest rates rose across the US economy, the unrealized losses, the mark-to-market, so to speak, were increasing tremendously, mostly concentrated among their holdings of mortgage-backed securities and among their treasuries. So the key thing here is this, is the treasuries have roughly no default risk. The mortgage-backed securities on the banks' portfolios are dramatically safer than they were in the 2008 financial crisis. But even still, while they're not subject to any out of the ordinary credit risk or default risk, they are subject to interest rate risk. Value of the securities falls as market interest rates go up. So Janet Yellen, Treasury Secretary, she's made it clear that at least in the short term, deposits across all banks are being protected. But she's waffled. She's kind of gone back and forth. So we're not 100% sure on how binding that is right now for other US banks, especially large ones. In order to increase the current $250,000 per account insurance limit, this would take congressional action. And this, of course, becomes a clear political issue. And the important thing to keep in mind is this, is that if you protected all deposits or even more deposits against current issues right now, that might help and probably will help calm the current problems and especially reduce the risk of them moving to other banks. But what you might do is increase longer term problems as depositors would have far less incentive to do any sort of due diligence, or in the case that perhaps maybe the SVB depositors maybe diversify their account holdings a bit more. So let's evaluate the policy response. So the FDIC closed down SVB on Friday, March 10th, and it was a somewhat disorderly and at the last minute shutdown. Usually these are very orderly, but it was disorderly because of the speed at which deposits were being withdrawn. On March 12th, Janet Yellen announced the systemic designation and that all SVB deposits were going to be guaranteed. And they also, and this is a big deal for them, is they tried to go out of their way to make it known that the broader banking system and the financial system as a whole were sound. And the objective here is to, of course, reassure the public so that not everybody goes and tries to withdraw all their money all at once. The Fed also developed a brand new policy tool called the Bank Term Funding Program. And this is backstopped by up to $25 billion from the US Treasury to insulate the Fed from any losses, even though these are probably pretty unlikely. So the Fed also, and this turns out to be kind of the big deal here, the Fed dramatically eased the borrowing terms of its original policy tool, the discount window, and expanded what are called dollar swap facilities with other central banks. So we'll go through these here one at a time. So the Bank Term Funding Facility. So what they set it up was this. They set up this new facility designed specifically for this particular situation, where what a bank could do is they could take treasuries on their balance sheet, mortgage-backed securities, and other high-quality assets, and they could swap these for reserves. And so I've drawn a little tiny balance sheet up here, just the asset side of a bank. And so the way the bank's asset side of its portfolio would change is they would give the Fed $10,000 in, say, treasury securities, And the Fed, in turn, would give them $10,000 in reserves, which they could then use to, for example, satisfy deposit outflows. The main reason for the Fed doing this is to help prevent any sort of fire sale of these assets, because what SVB tried to do is what they had to do is they had to sell some of their assets. If lots of banks had to sell mortgage-backed securities and treasuries to finance deposit outflows, that would cause a dramatic decline in those prices and a dramatic increase in interest rates. So the Fed was trying to prevent this by allowing banks to simply swap those securities for reserves without having to sell them and without pushing up interest rates and down the prices. A couple of interesting features here. First is these securities are accepted at par, not, and this is critical, not the market value. Moreover, there was no haircut, because normally the way the Fed does collateral, by the way, all Fed loans that they make have to be collateralized, is the collateral is generally valued at market price, which seems very reasonable, and there's what's known as a haircut. In other words, for every dollar in borrowing, more than $1 of collateral must be put up. So the Bank Term Funding Program made a whole bunch of news. Making a lot less news were the very interesting changes the Fed made in their OG policy tool. That's the discount window, the ability of the Fed to loan reserves to banks in the financial system. So generally, following good central banking practice, they set their discount rate above normal market rates. So the old saying is lend freely, but at a penalty, because the Fed, in normal terms, doesn't want to be a source of cheap short-term funding. Well, they reduced this penalty down to a very tiny level relative to general market interest rates. And they did this to encourage more active use by the banks of the discount window. And as we'll see, they did. And they also extended the term up to 3 months. They could repay these loans anytime they want, and they were renewable on a day-to-day basis if they so chose. Now, dollar swap lines. During the Great Recession, the pandemic, this was an extremely valuable and useful tool, not just for the US financial system, but for the world financial system. And here's the idea, is the US dollar is extremely heavily used by a lot of the rest of the world. And so in times of financial and economic stress, historically, there's a flight to safety toward US dollars. And around the rest of the world, this makes US dollars relatively scarce. And so what the Fed has done is they've used these dollar swap programs. And this, that's exactly what they do. The Fed trades US dollars for foreign currencies. The foreign currencies are kind of like collateral. And so, for example, with the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Swiss National Bank, the Fed has said, okay, what you can do now is not just on a weekly basis, we'll do these swaps. We'll do them, if needed, daily, where these other foreign central banks can give the Fed their own currency. The Fed gives them dollars in return. And then the other central banks can lend them out to their own banks for use. So in other words, this alleviates the scarcity of dollars in the rest of the world's financial system. So the general idea of the BTFP, the discount window changes, and the dollar swap facilities were to provide confidence and to add liquidity to the US and the world financial system. So to what extent are these policy tools being used? Now here's a thing to keep in mind, is sometimes just the existence, knowing that a lending facility, for example, is available for use, might be sufficient to calm the financial system. Well, so question is, what's the use here? Well, the BTFP, not quite $12 billion as of the week of March 22. That seems like a lot, but really it's not all that much. Discount loans, and this, I've got a great visual on this in a second, $153 billion as of March 22nd. And the swaps, at least as of now, no real action there yet. So here's the visual of the discount loan. So this is the the primary credit facility right here. This is as of Wednesday, just a few days ago. And notice, so my data go all the way back to just into 2021. And you can see here on the very far right, the dramatic increase in the use of the discount window just in the last 2 weeks. So what this tells me is that banks are very interested in having especially high levels of liquidity, and they're willing to borrow a great deal from the Fed in order to make sure that they've got that. So let's take a look at the Fed's policy decision for March 22nd. Let's just do this quickly here. So they did, and this was more or less as expected, they raised the target rate of their federal funds rate to 4.75% to 5%, because they're still worried about inflation. But what they also did is they added some very interesting verbiage to their policy statement. The U.S. banking system is sound and resilient, again, trying to inspire confidence. Recent developments are likely to result in tighter credit conditions, we'll talk about these in a minute, for households and businesses, and to weigh on economic activity, hiring, and inflation. In other words, sort of getting ahead of myself here, but what this will do is tend to act to reduce aggregate demand. So it will act like an increase in interest rates. So this is one reason why perhaps the Fed went for only 0.25%. And the reason for this is that they are surely seeing risks to the U.S. economy, and that issues in the banking system might themselves act slow aggregate demand. So let's take a look at the impact on financial markets. In general, we've seen a decline in overall equity prices, and most especially, unsurprisingly, bank stocks. But there's been a pretty significant difference across the impacts. In other words, it hasn't been all banks. It's been banks that look like SVB, for example. In other words, high uninsured deposits as one metric there. We've seen a decrease in treasury rates, in other words, a flight to safety. The US dollar is actually down a little bit, and so this suggests not a particularly high demand, and so that would be consistent with the fact that there wasn't much need for the dollar swaps we talked a few minutes ago about. In the treasury and mortgage-backed security markets, there's been a significant tightening of liquidity. In other words, it's been a little more difficult to trade these securities, looking at, for example, bid-ask spreads and so forth. And one of the objectives of the BTFP is to reduce the pressures on liquidity in these markets, making it so that it's not so much necessary for banks and other institutions to sell these securities. They can simply swap them to the Fed. We've also seen higher credit spreads. In other words, higher differentials between risky debt instruments and less risky debt instruments, like, for example, U.S. Treasuries. In one of the modest upsides here, there's been a not insignificant decline in mortgage rates. So in the Fed's verbiage, going back to the previous slide there, is financial conditions have tightened somewhat. Well, how do we measure tighter financial conditions? Well, there's lots of ways, but one of the most convenient ways is the St. Louis Fed's Financial Stress Index. It takes a whole number of measures, like, for example, credit spreads or in the general level of interest rates and so forth, and combines them into a single index. And 0 is defined as the average over time. And so what we've got here is a significant deviation, or in other words, one standard deviation away from normal conditions. And notice how quickly the stress index has elevated even in the last 2 weeks. Certainly, it's not what it was during the pandemic, but we're very early in the process here. So the overall impact on the economy, I'm recording this just a bit over 2 weeks post SVB's failure. So we aren't yet ready to talk about long-term impacts. I am not Nostradamus. What we need to keep in mind, though, is that in general, financial panics can have very long-lasting effects, especially if they're large enough. And as noted, the main impact is a decline in aggregate demand. We see consumer and business confidence decline, And in our particular case here, we might see lending and financing volume decline, and so that reduces spending by business. If these financial panics are severe enough, these can cause very long-lasting recessions and very severe recessions as well. So, for example, the best recent example is the Great Recession. We're not there yet, and I hope we don't get there, and I expect that we probably won't. So at least as of right now, again, we're only 2 weeks into the problem, the fallout is relatively, that's the key word here, relatively limited. So we've got SVB, we've mentioned Signature, we've got First Republic having problems, and of course we had Credit Suisse to be purchased by UBS. All of these institutions have had various and very serious ongoing problems. SVB was the first one to fall. When one bank falls, it's always the case that people look around and wonder, okay, who's going to be next to fall? And that's how you can get the contagion. And that's why Jerome Powell and Janet Yellen and other regulators are working so hard to, at least for now, limit the contagion. It's possible that if SVB hadn't failed, Signature might not have failed. Again, that's only speculations, or they might have been at least more or less okay. They might have been able to sell some assets. They might have been able to generate funding. Again, the whole key here is preventing a larger cascade. Another impact on the economy could be, well, will banks tighten lending standards like they did after the Great Recession? If this is the case, this will also work to slow aggregate demand. And the impact, especially from the banking sector, would be most felt by small and medium-sized businesses because they are very dependent on bank financing. They don't have direct access to capital markets like larger companies do. So what about moral hazard here? So let's think about this for just a minute. So moral hazard exists when there are asymmetries, in other words, differentials in terms of the payoffs. When you take a risk, you can get some reward, but there could also be some cost. If moral hazard is important, then the situation is this. There's the reward for the taking the risk, but the downside is somehow limited. The way to think about this here is that insurance is an excellent way to reduce downside risks of many, many activities. The difficulty with any insurance is that the insured have incentive perhaps to take risks that they otherwise wouldn't, simply because they are insulated to some extent on the downside. They get any upside, but are limited on the downside. So if you think about FDIC insurance, deposit holders have very little incentive to do any sort of due diligence, especially if their deposits are less than $250,000, because in the history of FDIC insurance, no insured depositor in the United States has ever lost a single cent. And so why would they do any due diligence? They would simply search around for the bank that offers, is most convenient, offers the highest interest rate, and so forth. But critically, in this situation, maybe bank managers might be willing to take more risks if their depositors were made whole in the event of some bank failure. In other words, you don't have a whole board of depositors coming after the management with pitchforks and knives, for example, in the event that the bank fails, because they're made whole by the FDIC. All right, so our summary here, as we've seen, SVB failed for a number of reasons, and that these reasons were all mutually reinforcing. The current impact is most seen in the tech and startup and VC sectors, because they depended on SVB and similar banks for funding. It'll be interesting to see, can they make that or those level of funding up? If they can, then the impacts will be relatively limited. Right now, so far, again, 2 weeks out, the overall impact on the financial system is relatively modest. The impact on the macroeconomy hasn't yet been seen. It's only been 2 weeks. But at least right now, if the fallout is contained, it'll be very difficult to find this in the aggregate level data. And then finally, going forward, how will the deposit insurance issue sort itself out? Will it be increased? there's a small chance it might. It's hard to tell, at least right now. There's a lot of politics involved. But the real question is, aside from will they be, should the limit be increased? Because you always do have to worry about moral hazard. All right, thank you all, everybody.